Let's talk a little bit about commodities. Commodities are a very important facet of what we're looking at because since we're living through threats of inflationary conditions, I think it's easy for you guys to see which way commodities are heading. And if you were to look at the first one, which is gold, gold prices have been climbing up for quite some time, and we clearly have the capacity to see that the trends of these particular markets are still very much upwards. And there are your trend lines. And although gold prices have come down since the highs, I don't see any breakage into that medium to long-term trend of gold. So we're still quite bullish into this aspect. I think gold is just making a little bit of a corrective condition. And I think that should be able to rectify itself after it finds heavier levels of support. Oil prices have also been shooting itself up. There was a little bit of a worry that took place in the early part of last week. But as you well know, a little crisis erupted in the Middle East, and we saw oil going back up to the recent highs, and it's currently still standing closer to about $90 or $91 per barrel. Copper prices, which is a good gauge of industrial movements into economies, is showing you that it's just pushed back into recent highs again, and that clearly outlines the capacity that demand conditions in economies globally are still relatively strong. And if you were to look at, of course, nickel, covering nickel now because there's been lots of interest in certain companies with this particular commodity. And nickel has just cracked the previous high over here and is now doing slightly higher than what it was in the last few weeks. All four are still showing very clear uptrends into the commodity sector, and you can clearly see why, of course, people have some abrasiveness in terms of inflationary threats. Now, in some headwinds coming into a few markets, let's just try to be able to look into the aspect of this. April discussed about inflation and interest rates. Let's just check to see also if the technicals seem to be looking into the same type of condition. And we'll talk a little bit about Europe's continuing debt problems, some geopolitical tremors, like, of course, what's happening in Egypt, and of course, some local concerns about the REITs, PPPs, capital raising things, but I will just talk about what is very much technical about most of these particular factors. I believe with each one of those reasons you see there, these are just excuses for markets to be able to do what they need to do, which is to exercise corrective movements. These are the things that we were quite fearful of in the first 2 years since the recovery of 2009, and we never really had any serious correction in between that time, except for maybe only a slight consolidation sideways. So we're trying to be able to pay for those conditions right now by making these reactive movements. And you can use whatever you want as a reason for these markets to be able to make that correction. In terms of inflation, I just want to show you that there clearly is some intent or the fear of that. April showed you also similar slides. This is core inflation in, of course, the Eurozone and in the United States. And they seem to be bottoming out already, and in fact the Eurozone is already showing some upside pressure. So it looks like the trend in that seems to be turning, and this is quite clear, of course, on that condition of that bottom out process. And below this is the Treasury bond yields, and you can clearly see a break into the downtrend line, a higher low being established back here just recently, and of course with bond yields stepping up. Bond yields are a precursor for interest rates, so usually if people are expecting interest rates to go higher, they usually buy this first. Or they sell the bond and the yield of the bond